Geoffrey Dennis is global emerging markets strategist at Citigroup, and he says unless the global economy slides back into a recession, investors should look to buy on weakness. He joins us now with more. Jeff, great to have you back on the show. You know, we've been talking a lot about the ripple effect of Japan and what is happening there, but what countries in the emerging markets area are most affected? Some of these, I was looking at your list, some of these are a bit surprising.
Yeah, it's primarily the Asian countries, as you might expect, for geographical reasons, although nobody really exports a lot to Japan, but countries like Thailand, Malaysia, Indonesia have a fair amount of exposure. But if there is a global theme about who exports to Japan, it's countries that export a lot of commodities. So Chile exports a fair amount, Peru, South Africa. So Japan doesn't have commodities, so it needs commodities, so commodity producers tend to export there. And so those would be the ones that will be hit if the Japanese economy slows down for a period of time.
Now, I think your economists are forecasting, what, 2.1% GDP growth?
We've actually just brought that down to not much more than 1%. So I think now what we're arguing is the disruption to the economy in the short term, supply chains, the sheer damage, the power rationing, simply the damage from the tsunami in particular, and let alone the risk of the nuclear situation getting worse, I think will mean the economy is weaker for a time longer than we thought, but it will recover second half of the year.
And how does that translate? Have you quantified specifically how that translates to a country like Chile? I mean, which one of these, you know, South Asian countries for geographical reasons clearly, but which one of these other countries is most affected? And
well, again, it's very short-lived, but it's very short-term. But our economists in Asia think that Thailand is possibly the most negatively affected. But again, you know, even a country like Thailand or Indonesia, you're only sending, you know, just into double-digit proportion of total exports to Japan. So it will have a small effect in reducing growth, and it will be very temporary because logically Japan will recover once the reconstruction activity begins after mid-year. But there is a short-term hit, no doubt.
Now I want to talk to you a little bit about emerging markets versus the developed markets. We've generally, back in February, there was quite a spread there in terms of underperformance by the emerging markets benchmarks versus, say, developed country benchmarks. Do you expect that to continue?
It's begun to narrow a little bit. We've lost about 1/3 of the underperformance that we saw from early October to the middle of February. We've recouped a little bit of that. But oddly enough, it's happened because emerging markets have been flat while developed markets have sold off. So we haven't really seen a rally in emerging markets yet. It's just developed markets, obviously, after their very big run, did have a pullback. Our house view is that emerging markets will rally over the rest of the year. They will outperform developed markets or get some of their excitement back that we had last year.
We're just looking at a chart right now, sort of year to date. You're saying we'll actually see this white line pass over the yellow line.
Correct. Over the course of the rest of the year. We're about 400 basis points behind. It's not a very big move. The move really happened because people got worried about emerging market inflation interest rates. We think you're beginning to get well through the interest rate cycle now in emerging. Also, it began to happen because everyone got excited about the U.S. economy in the fourth quarter, which started to look better. And we wonder whether there'll be a point where the upgrade process of the U.S. economy begins to fade. And when that happens, perhaps people will come back to the emerging markets where, to be honest, there's much stronger growth.
With our eye on emerging markets, we've got Jeff Dennis here of Citigroup. We're going to shift our focus. Again, we talked about this a little bit, President's trip throughout Latin America. It's sort of taken a back seat. Obviously, headlines have been dominated by what is happening in Japan. But what is he trying to accomplish there? I'm
sure he's trying to improve business relationships between Brazil and the U.S., which is significant, but they could obviously be more than that. I suspect that under the new president, Dilma Rousseff, Mr. Obama may be trying to discourage some of the slightly more unusual political responses that you had from Brazil previously, such as not signing up to the Iran sanctions, for example, earlier on a few years ago. Brazil is also looking for a permanent seat in the Security Council of the UN, and maybe that was a discussion point.
Now, is the president not supportive of that, and why?
I'm not saying that he's not supportive of it. I suspect he probably is, but of course there's quite a few countries to kind of shoehorn into the Security Security Council. I think the other thing that's going on is presumably that Brazil has suffered very dramatically from a weak dollar. It's trying to hold its currency down because it's losing competitiveness on the export side. And of course, one of President Obama's goals, the U.S. goals as well, is to encourage the Chinese to let their currency appreciate more. So we may well be trying to line up Brazil to get support from Brazil to push the Chinese a little bit more to let their currency appreciate. I think so. Those are some of the agenda items. All
right, let's talk a little bit about another factor that's been moving markets, oil. Right now I'm looking at crude up $1.65. We're right around the $104 level. This is also something that's a drag on global GDP. I mean, big factor, but how does that play specifically into emerging markets?
I mean, simplistically, we export most of the oil in the world and the developed markets import most of it. So from a point of view of does it impact developed versus emerging more, I think we get some marginal benefit from that. But there's
emerging
no doubt,
markets is we here.
Because we not a lot of oil is produced in the developed market world apart from the U.S. and Canada. But our view is that the oil price can go quite a bit higher without destroying the global economic recovery. Our view is that you have to buy these markets unless the global economy is going back into recession.
How much higher?
Well, our economics team are saying, you know, $30, $40, $50 more before you, in other words, the 140 range, the 150 range, for a sustained period of time before you destroy this global recovery. It's fairly early in the global recovery. It's a little bit lighter than normal in terms of the pace of growth in the developed economies. So we are fragile. We are somewhat vulnerable to a higher oil price, but we don't think this gets the job done. In other words, I think the global economy is okay, and if the global economy is okay, you have to buy the emerging markets.
All right, Jeff, always a pleasure to have you. Thanks so much for joining us today. That was Geoff Dennis of Citigroup. The latest on how Japan is affecting the emerging markets.